My name is Jeff Kresge, and I'm the general counsel for the agency. I'm the chief attorney for the office, and my job is to oversee the attorneys that we have. We have law enforcement officials there. We have compliance examiners as well. And the job of the agency essentially is to enforce the Kansas Securities Act. And that's done in several ways. One is we handle investor complaints against investment advisors or other people selling securities. We also examine investment advisors, stockbrokers, and brokerage firms in the state of Kansas to make sure that they're following not only their own rules, but our rules as well. We also are responsible for licensing or registering investment advisors or brokers in the state of Kansas who want to become investment advisors. So we come at this from a holistic approach to provide our citizens with predictability, safety, and market integrity. When I was in private practice, the focus of my practice essentially was representing investors who were involved in securities disputes. So I sued stockbrokers for a living for about 10 years. So I come at this from a very different angle. Not one of distrust, but maybe of healthy skepticism. You know, if somebody's selling you something, it needs to be what they're offering. They need to have the credentials to be able to do so. But probably 95% of the cases that came into my office, the cases that were good, the cases that we were able to resolve with a favorable settlement to my clients, could have been avoided by education. And that is very broad because just like anything today, information is everywhere. I mean, if you Google mutual fund, you'll be there for weeks. If you go into the library and look up modern portfolio theory, you're going to get a book about this big and about four more that you'll go check out, and you probably won't understand the first time around. So we have investment advisors who do that job for us. Most of the time, they do that job correctly. However, the purpose of our talk tonight is to arm you with some basic elements, some educational elements, so that you can go in to those meetings armed with some basic information so that you can help yourself in terms of communicating with those investment professionals so that you can get really what you need out of that. So the first topic we have is having a financial plan. Well, that's why you're going to a stockbroker or an investment advisor, because you don't have one. Or maybe you have one that doesn't make sense anymore. Maybe you just lost 50% of your portfolio in the last 3 years. Maybe you got divorced, maybe you got married, maybe you changed jobs 3 times, and your money's scattered in every single different way. Figure out what you have first. This can be as simple as organizing your records, putting them in some way that makes sense. I've had a lot of clients that'll bring me a grocery sack full of stuff, and a lot of it's unopened. Okay, you got to at least open up your account statements and look and see, what does my pension plan have in it? What does my 401k have in it? It doesn't mean you have to understand exactly what all of it is, but at least have a baseline understanding of what you need. You all have goals. Most of them are tied to probably college planning or retirement. You've got to understand this is a marathon, it's not a race. When people get to the point where they say, my kid's going to college in 3 years, or I want to retire soon, or my mom's moving in with me, I need extra cash, that is not the time to go shoot the moon and invest in pork bellies or oil wells or a lot of things that some investment advisors want you to invest in. A lot of it is tied to very high commission products that are designed to be long-term investments, but if you're going at it from a very short-term attitude, that is a recipe, in my view, of disaster. So you have to be realistic. A lot of stockbrokers are going to tell you what you want to hear. Interview a lot of people. It always surprises me that we spend hours and hours and hours shopping on how to buy a new car. You're looking at reviews, you're looking at magazines, you're shopping all the dealerships, A lot of people open up the yellow pages and point to the guy in the corner and assume that it's all good.
Okay.
Right?
My name is Randy Mullick, and I'm the Director of Compliance for the Kansas Securities Commission. My job is to oversee the examiners that go out and do the examinations that Jeff talked about at the brokerage firms and the investment advisors. I've done this job for about 15 years. Prior to that, I was a police officer in Wichita, retired after 20 years, and went into the securities regulation. Spent a couple of years with FINRA, who used to be NESD. That's the private, what they call an SRO, self-regulatory organization. I was in Boston during those 3 years examining firms, and then came back here to the Kansas Securities Commission. As Jeff was talking about, I mean, in my role, I've been both an investigator and I oversee the examinations, and we've dealt with complainants / victims over the last several years, and primarily what we're trying to determine from people is really how much do they know about what's going on. You know, this idea about no quick fixes. There are no quick fixes. I mean, but you'll hear people that will tell you, I can get you 15%, I can get you 20%. You know, I investigated a matter that was actually nearby Lawrence about 10 years ago here, where a person claimed that if you invested $10,000 within 13 months, he would get you $110,000 in return. And this man took in over $6 million in this area doing that. I mean, it's amazing to think that people would see that, and essentially this was all a biblically based program that used a lot of terms out of the Bible. And you know, so the long and the short of it is people would see something that you and I normally wouldn't believe, but because a couple of people had gotten the money and they'd seen them in new cars, nice houses, whatever, and I don't want to spend a lot of time telling you war stories because there's hundreds of these types of stories, people would actually turn around and give them money. And one of the analogies I like to say is I've seen people write checks for $40,000 or $50,000 based on a cold call from California for an investment in some kind of a internet-based company. But a young woman, a Girl Scout, will come to the door with a box of cookies for $3.75, and they'll tell her, ain't no way. You know, won't buy them. But yet they'll give people $50,000 and never blink an eye because they've been convinced they're going to get wealthy. So again, you know, we talk about have a plan, you know, make sure it's attainable, no quick fixes. You know, you have to educate yourself. You know, it's like if you're dealing with an illness. You know, we can't be as smart as the doctor, but at the same time, you have to spend some time educating yourself of what's happening to you and what your treatment's going to be. The same thing would be for a financial plan or your financial wellness. You've got to have at least some understanding of what's going on. And nowadays, with the internet, libraries, the resources are there that you can do some reading, you can do some research on the internet, and you can find out information that will help you make a decision based on what you're being told. You know, we also talked about really understanding your current financial situation. You've really got to delve into this situation and really kind of know where you stand, know what kind of insurance coverage you have, know what kind of savings you have, what your 401k is. I mean, I've talked with people many a time, and you know, they may not even understand their own retirement plan that their company has sponsored, and oftentimes it's because the company really doesn't provide much advice on it. They just provide the opportunity, and therefore you get involved in it and you kind of find your own way, and every now and then they might offer a session, but there really is a lot of information behind that plan that you can learn about, because oftentimes it's nothing but a bunch of mutual funds that they've chosen within this pool for you to invest in, but yet you can go online and you can check all kinds of facts. You know, for myself, I use MSN Money. You know, that's one of the websites I go to. You know, there's just all kinds of stuff out there. And again, the literature from the Wall Street Journal, they had an excellent article just a couple days ago about investing in stocks and really what the risk is, how long, you know, what the return is versus the risk. And you always have to measure risk versus reward. You know, are you willing to lose your money? And people, a stockbroker and an investment advisor really will not tell you there's a possibility you could lose all your money. But if you saw 2008, it was a situation where the market was, somewhere in the neighborhood of 14,000, and it dropped, I think, to 6,700. Roughly a 50% drop, and it's taken all this time to get back.
And one thing I wanted to echo just briefly is on the education part is, it's really refreshing that everybody's here to get this type of information. When it comes to, when you're back at home, sitting in the kitchen, figuring out, what should I do, don't put yourself on an island. I think because we're in the Midwest, we're kind of, ingrained to the general good habit of you don't talk to people about your personal finances. I'm not going to ask you what you make. You're not going to ask me what I make. You're not going to ask me what my 401k balance is, and that's fine. You can, however, talk to somebody you trust. Do you have a financial advisor? Do you like him? Do you think he's just trying to sell you stuff? Does he call you once a year, or does he actually follow up with you? You're going to get all kinds of answers because there's all different kinds of investment advisors out there. Some are good and some aren't, just like there's good doctors, just like there's good dentists. People get referrals for those types of things, and a financial advisor really is no different. I always go back to the analogy of buying a car. You're looking at a new car. Your neighbor has one. You walk down the street. Hey, do you like your car? Is it reliable? Did you get a good deal on it? I don't know how much you paid for it. What dealership did you use? There's lots of ways you can kind of go around that touchy subject of money, because and this is a real frustrating part about when I was in private practice, is somebody's, let's say they break their leg at work. It's obvious you broke your leg. It's obvious that you're off work. It's obvious that you're getting work comp. Do you know that your other buddy who drove the forklift just lost his 401k in the stock market? How would you know? How do you know that his investment advisor is any better than yours? I can promise you, at age 60, you are not going to tell anybody that you just took a bath. Not going to happen. So this is really designed to be, let's get out there, let's talk about it a little bit more. Not so you're an expert in it, but so you're comfortable in it. Sure.
You mentioned interviewing financial advisors.
Mm-hmm.
My past experience trying to do that, they want money.
Investment advisors, and we'll talk about this briefly, investment advisors are different than stockbrokers. Stockbroker, think Edward Jones. They're paid by a commission, okay? They want to touch and feel and get to know as many people as they can. That's how they get their business. Most of the time, stockbrokers will say, okay, I'd love to help you out. Bring in your account statements. Let's look. Let's talk about it. Investment advisors are in the business of giving advice. They're in the business of financial planning. So they're going to want to charge you $250, $500, $750 for a big 3-ring binder that covers everything. Sometimes that's money well spent. Sometimes it's not. So everybody's in kind of a different boat. Good places to look, and I know I'm jumping way ahead here, is your bank. Most people's banks are going to have what's called a lobby broker, just to field questions. That's going to get you started. Edward Jones, without, I don't endorse anybody, but they're pretty plain vanilla. It's pretty hard to get into something dangerous at Edward Jones. That's just the nature of their business. Yep.
And they also, I guess I'm sitting here, because when I think investment advisor or stockbroker, I'm thinking a chunk of money,
Mm-hmm.
a couple thousand, 10,000. There's people out there who will work with somebody who's have $1,000.
Yeah.
Maybe I have $750
Mm-hmm.
or 500. Okay. And
Okay.
those are the ones that I guess I'm hoping you guys can kind of tell us how to find them out as opposed to opening the phone.
I think your bank, for somebody that's just starting out, I mean, we all had to start out, right? People say, oh, well, you're a lawyer, you've always made lots of money. Whatever. I mean, you graduate from law school, your first job stinks. I don't care where you're at. You know what? My 401k balance was 0. Well, there probably was a broker out there who assumed that, if I'm a doctor or an accountant or anybody else, that I'm going to accumulate money over a lifetime, because it's a marathon, not a race. and they hope that they can earn your business for a lifetime. Waddell and Reed historically is specialized in people that have less than $100,000. Almost all investment advisors or brokers are going to say minimum of 500 grand. Well, great. That's what they say. It's like going to an employer saying my minimum, salary requirements are 500 grand. That'd be awesome, but not going to happen. So don't necessarily, take all of that at face value, because, like any type of professional, doctor, lawyer, dentist, insurance agent, stockbroker, they're starting out too. They need clients. Just because they're young doesn't mean that they're bad. It just means that they're young. So it's a big puzzle, and that's why you got to interview people to figure out who do you get along with. So be patient. Yep.
Earlier you mentioned high commission products. Does that mean the broker gets a higher commission, and if you're working with one that's kind of shady, he's going to steer me towards all the high commission ones for him, and not necessarily the things that are best for me?
I've seen it happen. Absolutely.
In general, what would you say are high commission products versus?
Well,
Is there any way for me to know that?
Well, there's anything that typically, you can have what we call private placements, things that, such as a REIT, a non-listed REIT, a real estate investment trust. These are generally illiquid investments, and oftentimes they'll pay a 7% commission. So we sit down together and we fill out an application, a purchase agreement on a REIT that takes us maybe a total of 20 minutes. And you put $100,000 in, I made $7,000. That's a pretty good payout. If you put in $200,000, I get $14,000. It took the same amount of time to fill the form out. They generally pay out, a percent to a company, and then the rep gets the rest. So he's averaging 6 to 7, sometimes 8%. Generally in Kansas, what we find is investment advisors charge on average a fee of about 2%. Of your money that's being managed, 2% of that. From an hourly rate, we don't allow people to charge more than $250 an hour. And generally, they're somewhere in that time frame. Some people will actually say, if I do a financial plan with you and you actually come in and do business with me, I may waive the price of the plan and just charge you a fee. Now, again, when you're talking cost, this is pricing of securities investments is one of the craziest things, because they talk about transparency, but that's where the transparency ends as soon as they talk about transparency. and part of it is set up so that you really don't understand. And one of the things I'll talk about first is mutual funds. When you're talking about using somebody to help you invest, you can actually go online and you can invest in a mutual fund, what is called a no-load fund, where there's no commission, no charges up front at all. And Fidelity offers them, and many other companies offer them. Vanguard offers them. And you can invest directly in that, and you can continue to add money over the course of, on a monthly basis, yearly basis, that kind of stuff, and just keep doing it. Now, for a fund company, they may have 60 different kinds of funds. They may have an international fund, a stock fund, a bond fund. They may have a mixed. They may have a tech fund. They may do all these kinds of blends depending upon, might be an energy fund. So again, you can read, there's a thing called a prospectus, which are about that thick, and you can read a prospectus that tells you about the investment to kind of figure out what its objectives are, and it'll tell you kind of what its history is.
But nobody reads them.
Nobody reads them.
Just so we're clear, nobody reads them.
Yeah.
You got to pass them out. And to jump back to your point about education or commissions and interviewing people, ask the broker, how much do you get paid for this? How much will this cost me per year? Just like when you come to my office in private practice, how much are you going to pay me per hour? If I say, well, I haven't, are you going to hire me? I hope not. Mm-hmm. People don't like talking about money. They don't like finding out, how much are you making off of this one conversation? It's got to make sense. Even no-load mutual funds. If I put $1,000 in a no-load mutual fund, that first account statement again is going to show $1,000 went in. Now, there is no such thing as a free lunch, so every year that mutual fund is going to charge me some money. That pays for the light bulbs at the mutual fund company. It pays for the salaries of the army of advisors they have there. It pays for advertising. It pays for printing the prospectus. So it's going to cost you something. The point being is, could you get the same thing for less? And is it worth it? Do you need an oil and gas fund that's going to cost you, let's just call it $300 a year? Or do I need a value blend type fund that's going to cost me $125 a year? And a good broker is going to explain to you the difference. And if they can't, keep on looking.
Right. Let me just talk real quickly about price since he asked about it. There's an A share of a mutual fund, and those are typically sales charges that are up front. And they'll average anywhere from 5 to 5.75% if you're making a $10,000, $15,000, $20,000 investment. And that's typically for an equity fund, a stock fund. Now, and when we talk about a mutual fund, essentially you have a fund manager who goes out and they buy maybe anywhere from 30 to 40, 50 stocks that's in this particular fund, depending upon what type it is. And so that person's constantly managing the fund, buying and selling stocks to make the fund. So it's what we call diversified, because you don't just own one share of Ford Motor Company, you own 40 shares of all these different stocks by percentages. So it helps lessen the risk to you. Okay. They have another class called a B share, which is the same thing as the A, but a stockbroker can tell you, well, you don't pay me anything. The fund company takes care of me. Because when you make that $10,000 investment on an A share, you'll end up with 94.5% showing on your statement. So, it'd be like $9,450. You buy a B share, you're going to see the whole $10,000. Now, the sales charge is not up front. There's a higher administrative charge by at least 1% annually. That's how they make their money back. If you pull out early, it's what's called a deferred sales charge, and that deferred sales charge kicks in at the same rate of what the A share would have been. So they're getting paid when your money leaves, not when they first get it. And then there's a thing called the C share, which actually charges generally 1% sales charge within the first year, but it has a higher annual charge, usually equal to or a little greater than the B. So you're always looking at these amounts of money, and depending upon what question you ask, that's what they're going to tell you is, you don't pay me anything. The insurance company takes care of me. The fund company takes care of me. When we look at commissions, FINRA has a rule that says that a stock commission shouldn't be any greater than 5%. Well, we really don't see 5%. 5% is pretty exorbitant the way that trades are done now electronically. We generally see them averaging 2%, 2.5% on a commission. Now, again, the problem with this is you have on an individual equity, a stock sale, you can either get it in an agent capacity, where it's a commission, which means the stockbroker through his company has bought it off of one of the exchanges, generally the New York Stock Exchange, even though there's a lot of other exchanges. And you can also have a trade called a principal trade, where it means the company owns that position and they're actually selling it to you, so they can mark it up. It's called a markup and a markdown. Well, oftentimes that markup, markdown is very similar to a commission. They just have a proprietary interest in the trade because they own the stock and they'd like to get rid of it. And that's been one of the issues in the past, is sometimes they're selling stock they don't want to own, but they also have to oftentimes make a market in it, and that can be very profitable. So again, when you're looking at cost, it can range from relatively high to over here somewhere in the neighborhood of 1 to 2%. And sometimes you might say 1 or 2%. We're looking at an exam right now where we went into an office, and these guys are stockbrokers, the old traditional kind. They really don't like doing advisory relationships. And what we found was they were making high six figures in their business. And so we took a look at it, and what we saw was they were charging, their commissions were about double what an advisory fee would be. And their rationale is that their people really don't want that kind of service, of an advisory service, which doesn't make a lot of sense. And what we found out in looking at this is if we ask the clients, and that's what we're getting ready to do, is the difference between 4 and 2%, a person might say, that really doesn't bother me. I'm okay, I realize he's got to make money, but that difference could be, depending on the size of your account, anywhere from $2,000 to $5,000. And most people just won't naturally let $2,000 to $5,000 walk out the door. So again, cost is really something that you've got to understand in all these, whether it's a stock, a bond, a mutual fund, an exchange-traded fund, or direct investment. So as Jeff said, if you go see an attorney, you generally are going to want to know, what's it going to cost me?
Let me get this straight, okay, you're charged 2% on the amount of money that you give them to manage,
Mhm.
whether or not you make money? Like if you make money, are you still?
Yes.
Oh, yeah.
Yes,
Oh, yeah.
yes.
You're going to pay it
Yes.
coming or going.
Now,
Okay?
now the incentive for them is to grow your account through the investments, and generally that happens. Now, a market collapse like what happened in '08, they don't like that, because if it hurts your bottom line, it hurt their bottom line. Let's say I had $25 million under management and the market dropped 50%. Well, my portfolios all didn't drop 50, but I probably took at least a 30% hit or something like that. Well, there's been a lot of articles about how they were hurt. And so for them, they've got to, they need to see the market recover so that they can make money. But yeah, that's true. They get their money whether you make money or not.
Yeah.
You guys mentioned the transparency. What are is everything required to be disclosed to us? And what are the areas that we need to be aware of where things aren't so transparent, where we need to take an extra look?
Well, I'll tell you, anytime you do a purchase, you get what's called a confirmation. And in a confirmation on a stock trade, you're going to see a commission and you're going to see the markup. You get a confirmation on a mutual fund trade, all you see is the amount that you bought. There's no disclosure on that confirmation what your sales charge was. You have to find that from the prospectus. And it's listed in the prospectus, but on a confirmation, it's very simple to see it on the in writing. Now, for like a direct investment, a REIT, again, it's within the offering memorandum, which is basically a prospectus. It's a document that describes the investment, and within that document, it talks about what the payouts are.
So is the prospectus then the key document to get all the information about how the investment is managed and all the charges?
Yeah, I think that's your starting point, and it's, there's a table of contents, so you can figure out what the parts you're interested in. But I think, the important part here is to be your own advocate. Now you know that there's advisors and there's stockbrokers. They get paid in different ways. 2% a year. That's highway robbery. Why should I give somebody $5,000 a year to advise me if they're meeting with you once a year for an hour? Well, you probably shouldn't. That does not make financial sense. You should look at a stockbroker who is being paid per transaction. Depending upon how actively you're trading, a stockbroker commission type relationship typically is going to be less expensive. And everybody's situation is different. But taking your average investor, you should probably be looking or rebalancing your accounts once or twice a year. Okay? Let's say you've got $100,000 in your account. We got to sell a few things, we got to buy a few things to keep it all in balance. The commissions may be $1,800. Sticker shock, right? Well, same thing with an advisory fee. Except he got paid $2,000, do the same thing. You just have to look and see which makes more sense, and that's just part of asking those tough questions when you interview them. Why should I sign up with you, sir? You're charging me 2% a year. Well, I've got, thousands of different mutual funds I can offer you. And we can buy and sell as many as we want, and it's not going to cost you anything. So we're not going to churn your account. Well, sir, if you were a stockbroker, would you be churning my account anyway? He's not going to say yes. No? Okay? So, figure out what your own needs are. So going back to, what is your goal? Is your goal to be a day trader and you want to see how it's done? Well, if that's your goal, don't do it. Because they lose most of the time. But, if you just want to sock away $50 a month and build your retirement, you don't need to shoot the moon. So it's all linked together. Yeah.
Yeah, so say we've interviewed a few advisors or brokers. Can we call your office and find out if there have been any complaints against them?
Sure.
Or anything like that?
I wish you would, because nobody does.
Right.
And if they did, I'd probably be out of a job because there'd be nothing to do. But yeah, there is an extensive record of publicly available information.
Right. You can go to FINRA, go to finra.org, and you can do what's called a broker check. And again, we're talking the difference between an investment advisor and a stockbroker. Stockbrokers are paid by commission. Investment advisors are generally fee-based. So when you go to FINRA, what you're going to see is a stockbroker. So let's say you go see an investment advisor, and should you look on FINRA's website? Yeah, because some of these people actually are duly registered. They're both a stockbroker and an investment advisor, because they may get a commission on the sale of a product to you, as well as charging you for the advice that they give you. Now the SEC, federal SEC, Securities and Exchange Commission, at sec.gov, that's where you can go. There's a link there that will take you to the investment advisor check there. Now for us, we have a new website, and our website has links directly to both of these spots. So if you go to our website at www.ksc for Kansas Securities Commission.ks.gov, there's a section on there that we put together for investors, and it basically talks about having a financial plan and staying abreast of what's going on. And it also has the direct links to take you to the SEC's website. It can take you to FINRA's website. We also have our own internal records that Jeff was talking about that we may have. Not all complaints get put on these systems because they have to meet a certain threshold. If the complaint is less than $5,000, they don't have to disclose it on these websites. That doesn't mean that we don't have it. We may actually have it within our own internal database. But you have to call our office in order to get that information.
So we just call and say, here are the names of 3 people I'm considering, what can you tell me about them?
That's right. You just say, I'd like to check the background of my investment, an investment advisor or stockbroker of the company.
And basically, you're going to find out who they are they registered, which is really most important, because you're going to get a knock on the door, a phone call at some point, hopefully not, but in theory, from somebody who says, I'm a stockbroker from XYZ company, except they're really not. You can go on Craigslist right now, I can promise you, and you can find somebody that's going to sell you an investment in something. Keeps our guys busy. Yeah. I mean, we issue subpoenas to Craigslist, we figure out where they're at, what computer they're using, and where they live, and we'll knock on their door and tell them to stop.
Let's talk about some of the things that you'd find if you're educating yourself on these sites. Whether or not a person's ever had a lien against them, a judgment, which might be material for you to know, like they can't pay their bills, a bankruptcy. You'd be surprised how many people we have registered with us that have these kinds of disclosures. We have people that actually have tax liens from the Kansas Department of Revenue. And our position now is if you're not paying your taxes, you know, we're not going to allow you to do business in the state of Kansas. Now, some of these people actually aren't paying they haven't paid their taxes for a particular reason, but they may be on a payment plan with the Revenue Department. So for us, we don't want to shut that down. Criminal history, if they've ever been charged with a crime in which a crime of dishonesty, theft, forgery, embezzlement, I don't know what else, fraud.
Charged or charged and convicted?
Actually charged.
Yeah, and I mean,
And
brokers don't like this disclosure rule because, you know, they can get sued by a client and it could be a sour grapes complaint, but they still got to report it. And
Right.
so it makes it a little more difficult for, you know, one of us to go and decide, you know, how is this resolved. But I think importantly,
Gives them incentive for customer service and taking care of their people.
it does,
Mhm.
and you want to keep in mind, and you know, most people are flabbergasted by this, is that all you need to be a stockbroker or an investment advisor is a passing score. That's all you need, okay? There is going to be a brokerage firm out there that will hire a broker who's been sued 5 times, that's been bankrupt twice. They're just not going to pay them very much because at age 40 or 45, their life's in shambles. They don't know how to do anything else except sell securities. they know that there is some rinky-dink firm somewhere that will hire them. Okay? Now, 95% of brokers have a clean record. I want to make sure we get that out. 5% of them keep us busy. That's why we have the SEC. That's why we have, the bank regulators. That's why we have the insurance division. That is enough to cause questions, to cause you guys to question the integrity of the market. That impacts the flow of money back and forth. We want people to save. We want people to invest because it drives the engine that we read about every day.
Is that kind of listing only for people in that business, or if you're looking at a potential landlord or potential tenant, are they listed on a site like that too, on criminal records and liens on them and can't pay the bills?
No.
I mean,
no.
the Kansas Insurance Department is going to have records of their insurance agents. But if you're doing due diligence just on a private individual, it's a little more clumsy to do it on your own. You can go and search court records.
Yeah.
That's just not as easy to access. We want it to be easy to access. We don't want there to be any barriers for you to decide, should I give them control of, the inheritance I just got.
Yeah, and I would reiterate what Jeff said. I mean, the vast majority of these people run a very respectable business, and they've actually made money for their clients. And, that's whether you're a wealthy client or whether you're just an average client like us, average folk, that they've been able to do this. That's not to say that they don't make mistakes and they misjudge things, and that's when complaints come in. And in Jeff's former occupation as an attorney for the public, we had a situation within the last few years with the economic meltdown. A good example of too good to be true. Lehman Brothers were selling what was called a principal protection note, 100%. In essence, whatever you put in, you're guaranteed to get back, and so there's no risk, and you get all the upside, meaning if the market goes up, you get it. Well, the only problem happened, Lehman went bankrupt. So that 100% principal protection, zero. We have a case where a man went in and actually wanted to get out of the market and buy a CD, and he was convinced by the broker to buy one of these things because the broker thought, it can't go wrong. It's Lehman Brothers. They've been around for 100 years. And so this man put, most of his money in this. And it wasn't because the broker was trying to injure him. It was just an honest mistake. But, it still has some significant ramifications. So, again, I don't want to paint them all as bad. The problem you have is people come into this business at times and they don't have any background in the business. They've been able to pass the exam that Jeff mentioned. There's a couple exams that they can pass, and they get in there, and their income is derived primarily from selling something. If you come to them and they look at your, what we call a portfolio, your current investments, most of what you got is no good, and you need to buy something else, because through those purchases, they make money. And it's a very difficult, it's a difficult occupation. And one of the things you should look at is people that have been in the business a long time, because that creates history to kind of look through the market ups and downs. When the market's going up, we don't get any complaints. We've never brought a suitability case for somebody that made money. We only bring a suitability case generally if they lose money. But the investment was unsuitable either way. There's just no complaint. So.
Jeff referenced balancing and rebalancing. Warren Buffett famously said that the idea of holding critical stock is forever. What do you think?
Well, the theory that he mentioned was balancing and rebalancing your portfolio. And that really has to do with, I think, the stage in life that you're at and how much time you have before you meet your goal. If your goal is to buy a car in 1 year, well, conventional wisdom would say you're not going to put that money at risk to a substantial degree, because if that investment goes down in month 9, you're not going to meet your goal. So you're going to invest that more conservatively. If your goal is retirement at age 65 and you're 30 years old, conventional investment wisdom would say that you're going to put more of that money in stocks because you have the chance of higher appreciation over the long term. That money could be more at risk, however. So as you get older, that balance needs to kind of go from all stocks and no bonds to maybe a little more bonds, fewer stocks, until you get to the point of retirement where, let's say you're 2 years from retirement. Could you afford for your 401k to be cut in half because you were loaded up in stocks? No, because you don't have the time to make up for it. So when I talk about rebalancing, the S&P 500 has gone through the roof the first part of this year, 9% annualized. Okay, so if your account was, say, 50-50, 50% in stocks, 50% in bonds, because that stock portion has grown, now all of a sudden you've made money. Okay, well now maybe you're 60% stocks and 40% bonds. Okay, during that annual meeting that you should be having with your broker, he probably is going to suggest, hey, let's sell some of this, let's take some profits, invest it back in the bond section or somewhere else to get you back to that 50-50 mix, because you're making money. You see it, the bottom line. Nobody's going to complain because they're making money, but before you know it, you're creeping up to 70-30, 80-20, and you're happy because you're making money. But if you get a market correction, this part goes poof. And then you call our office and complain. My first question is going to be, did you read your account statement? Did you understand it? Did you call your broker? Did he explain it to you? Did he tell you to write it out? Did he tell you to go, don't worry about it, you're making money? That's when I get involved. Or did he say, you know what, we should really, let's get off the roller coaster. And you say, oh, well, we're making money. I'm going to stay here for a little while. That's when we close the file. It's partly the investor's responsibility, too, to understand what's happening. Okay?
Yeah, question?
It sounds like the bottom line on investing is that easy come, easy go adventure is usually a game for the young. When you're more interested in protecting it than necessarily growing potentially by leaps and bounds.
Right.
Probably better to, well, like I said, a more conservative investment may not grow as potentially fast, but it won't plummet as fast either.
Right.
Correct. Volatility.
But I'd say the last several years have taught us a lot about what we thought were quality investments, and I think the lesson we've learned is we don't really know what a quality investment is because it changes. Yeah, I mean, I think your question about, do you buy and hold? I mean, you think about General Motors. I mean, people that work for General Motors and went out and bought company stock maybe got it, and it essentially became worthless. Ford Motor went down to $1 a share, and they didn't take any government money. Enron, look at that company. I mean, the same thing. A lot of these companies that we thought were, the pinnacles, and there's still a lot out there that are good companies that are still those pinnacle companies, but the problem is you can have one that you thought was, go to one that we've seen more recently, and I think history tells us you have to be careful on how much and how long you're going to stay in any given position and how much exposure you're going to have, because it's all about risk, and you have to ask yourself, could I lose it tomorrow? And the one thing I would throw in this group tonight is I have seen it time and time again where a consumer gets nervous about the market, calls their stockbroker and says, I think I want to get out. I think I want to move to a certificate of deposit. And the broker says, write it out, And as Jeff says, at the point you say okay, you pretty much have ended your case. What you need to do, if that's how you feel, make that decision and go to something safe. Now, if the market goes up 30% and you missed it, you can't blame your broker. But, when you go ahead and let them somewhat talk you into writing it out, because that's what people do, you've essentially consented to that transaction or that objective. Yes, ma'am.
As a measure of quality, would you recommend buying stocks with a lot of insider ownership?
Well, I don't recommend, I can't recommend anything at all, but I think you certainly have to look at trends, but even those situations when you talk about insider ownership, again, insiders in some of these companies have been hurt dramatically, because they held such a high percentage. What I tell people is you need to get out there, you need to take a look at it. Jeff talked about the S&P. A lot of times you hear about the Dow. The Dow is 30 stocks, And, you know, that's what they like to throw on TV is where's the Dow at? It's at 13, it's going to 14. The S&P 500 is 500 companies. It's a broader look at the economy as to the health of the economy. And that's really what, if you're trying to kind of gauge the economy, I would really focus on the S&P 500. There's a lot of other indexes out there that cover certain areas. Yes, ma'am.
Yeah, so I have a little bit of stock that I purchased directly, and then somehow it's managed by some broker a long ways away, and I was told that not everybody can, like not just any broker could handle that. What determines who can manage what?
Well, it may depend upon what kind of, if it's a thinly traded stock, if it's something that's not on an exchange where you can price it, then sometimes it really depends on the custodian. I don't know if it's a retirement account. If it is a retirement account, sometimes if it's one of those thinly traded or illiquid type stocks, that may have to be even in a trust company because some clearing firms won't actually hold that particular kind of a security.
Typically in that situation, there's an arrangement between that brokerage firm and maybe the company as to who's going to administer that stuff for us.
It's almost like an exclusive.
For instance, but you need to find out, is it truly exclusive? A good example is, my wife had a 401k at a prior employer, and it was managed by this third-party, administrator, and they did it for all the employees. Okay, well, she moved companies, so that money's sitting out there. All right, well, she goes to a new company, and they kind of start the 401k over. So our stockbroker says, well, why don't you transfer this old 401k, over here to us? And I said, well, do you have any problems with what's invested in? No. Okay. Well, what are the fees for this? Pretty low, because they have to administer, thousands of employees. So they really price that down versus moving it over here. And, I've got no problem with my guy making some money, but what's the point, right? And so you gotta have to look at the big picture as to, maybe it's cheaper to keep it at this place far away, and if everybody is fine, that's fine too. The best way to find out is to go to, your broker or somebody else and say, hey, can you get this money over here? He'll find out. I can promise you that. He'll do his best to find out if he can.
Yes, ma'am.
That makes me wonder if there's, we had medical analogies tonight, if there's an ability for a second opinion. You were just talking about, okay, I'm feeling like maybe I want to get out, but my broker's saying, hey, write it out. Then, is that something you can do? Is there another
you can
say, how would?
Yeah, what would you do?
Yeah.
What changes should I make? You can do something like that without, and sometimes they'll even do it as a precursor without even paying them, to simply to sit down and interview them and say, here's my current portfolio. If you had my account, what would you do with it today? What kind of changes would you suggest, and what could I look to see? And so, that's a possibility. The one other point that I would try and really push hard tonight is don't let people off the hook by giving you an answer you don't understand. If you don't understand an answer, have them explain it until you do, because again, it makes Jeff's former job very difficult. If you're saying okay and you really didn't understand, if you didn't understand, you have to say, I really don't understand. You're going to have to explain this in terms where I can understand what this investment is, what it does, how it works, how am I going to make money, what's going to happen, where's it at. There's all kinds of questions like that. Where your bank's at, where your savings account is, how you get to your savings account. You need to have the same understanding to your investments.
That's a tough habit to get into, because most people, when they're meeting with a stranger, are going to say, you know what, I've got no clue what you just said. Because people are proud, they work hard, they've worked for their money, and you know what, that's oftentimes, by the time retirement rolls around, that's your biggest asset. And you know what, you're scared. What am I going to do with this thing when I retire in 2 years? I don't know. And you're going to go to hopefully 2 or 3 or 4 advisors, stockbrokers, your bank, and get a general idea of what you should do. And a good broker is going to sit there and they're going to explain it to you. And another good rule of thumb is if you don't understand the investment they're suggesting, maybe you shouldn't consider it. Because if you don't understand it now, I can promise you that if it goes down, you're really not going to understand it, and they're not going to tell you. Because they've already made their 7%. So, treat your investment advisor like you would your doctor, your lawyer, your banker, your insurance agent. You want to know.
Yeah, I mean, I've seen people take, cash advances on credit cards for an investment. They've been promised that they will make a profit and pay the money back before the first payment's due. They never see their money again. So not only did they lose the money, they're paying an advanced rate of, 25, 30%, because it's a cash advance, one of the highest rates you'll pay.
Or take out a second mortgage. Don't do that.
Yeah, yeah.
For retirement benefits, are there any insurance companies you would recommend?
Well, we don't recommend companies at all, but insurance companies sell a lot of products that are represented as investments. One of them is variable annuities. They'll talk about variable annuities. It almost sounds like a Lehman note in some ways, because they'll say it has a guaranteed death benefit. You put $100,000 in, $100,000 will go to your estate, your heirs. It has the upside of the market in what's called sub-accounts, which are nothing but mutual funds, but it has some fairly high, M&E expenses, which the mortality and management type stuff. And so they're subject to market fluctuation. The other thing that people will market from an insurance company is what's called a fixed or an indexed annuity. That's where they'll guarantee you 6%. Well, the problem with that 6% is that's all you heard in the fine print. What it says, it's 6% based upon, the cow jumping over the moon and, minus, an equation that I couldn't figure out. And ultimately it ends up about 2.5, and you're kind of trying to figure it out, but it's all in the prospectus. So again, you have to really understand that these products are designed for certain things. First and foremost, they're life insurance is what they are. They have an insurance rider to them. And the investment feature is really a second feature. That is not the primary feature of them.
Nothing wrong with variable annuities, nothing wrong with equity index annuities. Again, they're just not for everybody.
Mm-hmm.
If you're going to go buy a car, you need a regular car. You don't need a Suburban. Well, how did I get him with the Suburban? Well, because he sold it to you, and you bought it. Just like a variable annuity. You don't come into your broker and say, you know what, I would love a variable annuity. Please, I want to see all the ones you have. It doesn't happen. High commission product, okay? Got a lot of restrictions. In some cases, they can be totally appropriate and totally beneficial. Goes back to education. What is it? How does it work? How is it different than a mutual fund? Do I need it? So I hope some of this has kind of empowered everybody to just ask questions, because it's your money and you are 100% in control of it up to the point where you write the check. So again, this is, like I said, most folks' biggest asset come retirement. And if you're younger, you want it to be your biggest asset come retirement. We don't want to get into the Social Security talk. But tonight it's a different subject. So knowledge is power. Use our office for a resource. We're going to tell you everything that we're allowed to tell you. We can't give you financial advice. I can tell you if somebody's, gone through bankruptcy, or got a DUI, but at least it gets you on the right path, and hopefully you'll leave with more information than you came with.
Well, one thing I would throw in about investments that are hot right now are oil and gas, because gas at $4 or something a gallon. We actually did a seminar a couple of years ago, and we used an oil and gas company in Wichita to put it on for a lot of the regulators. And the reputable ones, they actually have a bank of investors who have money just waiting to invest, people who are wealthy, who continue to put money in this, and they stand at the ready to contribute money. So when you get a cold call on an oil and gas opportunity, it's generally somebody doesn't have a lot of experience, probably just started up, does not have this kind of track record, and the risk just go up tremendously from that. So again, oil and gas, people do make money at it, but the reputable companies will tell you from the get-go, their investors are lined up and waiting for them. Anytime they get a new well, they make a phone call, the money comes in. So, just one to be on the lookout for. Yes?
So what is the basic difference between a stock and a bond? I know that's
Okay.
a basic question.
Well, a bond is debt, whether it's debt with the United States government or it's debt with a company. A stock is equity in the business. A bond supersedes a stock in the hierarchy. If the company is going to be dissolved in any particular sense, a bond will be paid back first. Bonds earned usually a set amount of interest. Whether it's a municipal bond, which is backed by the municipality, water district, treasuries, U.S. treasuries, that kind of stuff. So they generally have a set rate.
That's why they're considered safer?
They're safer, yes, yeah. They're not as volatile, and they stand, typically if they're issued by the government, depending on which kind of bond they are, they're generally backed by the government, so you're going to get your money back. But T-bills and government bonds don't pay a whole lot right now. But when you go over on the stock side, you're actually making an investment of capital in the business, and there's no debt to you. You just have an ownership interest in that business. And any liabilities that the company owes are paid before you get any of the final payout. So you could own stock in a company like just a company, and essentially the company has liabilities that exceeds its assets, and if it goes out of business, you can be holding a stock certificate that's worthless. And even bonds have become worthless too, but again, typically those are safer than stocks, but again, it depends on who's issuing the bond. Government bonds, generally still the best faith to invest in.
I want to ask a question about the history of investment advisors. When did it become popular for them to manage people's money?
That model has been around since
1940.
The Investment Company Act of 1940, the Investment Advisory Act of 1940. We've seen a big shift part of the last 5 years to that model, and a lot of it is because brokerage firms are, in my opinion, making it very difficult for their agents to earn the living that they think they should be earning in terms of sales quotas, production, things of that nature, making the payout smaller, or the cut of that commission smaller. And so you see traditional stockbrokers going out to the advisory side and thinking they can do it better. They have access to the world of mutual funds and stocks. They get paid differently, and again, some people are cool with that, some people aren't. But the traditional broker dealer, I think, is always going to be there. I go back to Edward Jones, Northwestern Mutual, Waddell and Reed. There is certainly a place in the economy for them. Some folks just want to have the flexibility of paying that 1 or 2% a year, and they're okay with that.
Yeah, there's about 5,000 broker-dealers across the United States, and they can range anywhere from a single shop to the Waddell and Reed. There's about 35,000 investment advisor companies across the U.S. Again, they can range anywhere from a one-person shop to a group of thousands, depending upon which company it is. So in Kansas, we have about 160 state-registered investment advisors. Those are advisors with less than $25 million under management. Under that Dodd-Frank law that just came out last year and a half ago, we're going to go up to $100 million of monitoring that group. And above that, the SEC, the Federal Securities and Exchange Commission, will continue to monitor the larger group.